So I think stocks can still have multiple expansion if rates move higher from here. But of course, 2.8, if we stay at 2.8 the rest of the year, I think stocks can rally.
Another headliner, Tom Lee, who says it's no surprise stocks are struggling recently, and Uncle Sam is to blame. He joins me now at Post 9. So it's all Uncle Sam's fault, tax day, and then everything's going to be cool?
I hope things get better, but yes, this year, April 18th is tax day. It's an extraordinarily big tax hit. We calculated what we estimate Americans owed. It's about $828 billion, excluding crypto. Crypto is probably another $125 billion in taxes owed. So about $1 trillion went to Uncle Sam today.
And no, but you think literally, like you get today out of the way, and then there's a noticeable and notable impact in the market?
Yes. We looked at years where the market was strong. The 2 weeks into tax day, our markets are weak. There were a lot of folks caught off guard because they thought they had until October, and of course they don't. They have April 18th. So there was a bit of a frantic push, and hopefully this takes away indiscriminate selling.
Okay. We have to discuss this tweet of yours where you agreed with somebody, and honestly, I saw this over the weekend, and I was like, what? I was like, what is Tom talking about? So I came into that. I was like, we got to get Tom Lee on. A gentleman by the name of John Carter tweets the following: the increasing shift out of financial assets into hard assets will soon turn into a panic move. And you said, agree, 100. And I'm like, wait a minute. Tom Lee comes on the show and he's bullish and he says the lows are in for the year, and now you agree 100 that there's going to be a panic move out of financial assets. I'll let you explain how that makes sense.
Yes. Well, because not all assets are equities. There's a lot of financial assets that are terrible inflation hedges. Americans today own $55 trillion worth of bonds. And they are going to get their quarterly statements. Bonds are down 7%. 25% of all 10-year periods since 1880, bonds have had a negative realized return. We're probably entering another decade. So there is going to be this, we believe, a panic out of bonds. It'll go into income-generating real assets. And a big chunk, we think, will be TINA, which ends up in the stock market. So I don't think people are going to sell stocks to buy real assets, but they probably will sell a lot of bonds.
So you're talking specifically about the bond market and money coming out, because it doesn't say that. When I read this, I was like, what?
That's right. And I probably intentionally left it a little vague just because, you know, it's the weekend. I was having a little fun.
Okay. You knew I was going to call you and be like, what in the world is this? In all seriousness, you do have people suggesting that there is an alternative, that TINA's no longer TINA, that maybe bonds are an alternative to stocks.
Yeah, I mean, it's getting to be very tricky now because we have inflation that is quite elevated. We don't know if it's going to cool. Hopefully, that's our base case, that it cools. And we know that bonds yields have moved to a level that people might want to actually own some bonds. But the reality is if rates do creep up, so we have positive real rates, meaning, you know, the 10-year goes towards 4 or 5, anybody who owns that $55 trillion bond complex is going to lose another 10%. So you're talking $5 trillion of realized losses if people don't rotate out of bonds.
What do you make of the fact that interest rates, they don't seem to want to go down right now? That sort of throws a wrench into your bullish thesis if rates continue to rise. It's one reason why the stock market seems to be having fits and starts, with all due respect, aside from Uncle Sam wanting his or her money.
Yeah, stocks have been tough. You know, we still think February 24th is the low. I think there's a lot of fear in the equity markets towards the Fed. But I think one thing just for the viewers to be comfortable with is there's already been a huge adjustment in mortgages. And auto sales are already rolling over, and they're super sensitive to cost of financing. So I think a lot of the work that the Fed wanted to see is being done in the bond market. 10-year at 4% is still a 25 PE for a bond. So I think stocks can still have multiple expansion if rates move higher from here. But of course, 2.8, if we stay at 2.8 the rest of the year, I think stocks can rally pretty strong.
Bullard, as we mentioned, sitting with Leisman as we speak, having this conversation in which he said Fed tightening is in the market. And that's been your sort of case for a while. Here's the conversation that is going on as we speak, and we've been bringing headlines because Bullard certainly likes to make them. Is it all in the market?
I think that there has been a lot of the work done by the markets on behalf of the Fed. So I think the Fed has been able to get long ends up. This curve is steepened. Cost of financing's up. We're already seeing some demand hit from higher gasoline. So if the Fed was worried about the S&P going up 10% a month, it hasn't been, and that's, I think, really helped make the Fed a lot more comfortable with where markets are. And I know Adam just previously was saying, and I kind of agree, I think that there's a chance that the Fed could actually make a dovish pivot towards the end of the year.
Man, I just don't get any feeling that anybody else is saying that, but you, Adam Parker, and maybe 3 other people I could find on a street corner somewhere. I mean, where does that view come from?
Well, I think that over the weekend, actually, J.P. Morgan Economists had a great study showing like the 4 types of inflationary items, things that are persistent and things that take, that are firming. A lot of these sort of things like auto sales, they're already starting to roll over, and they were huge contributors to CPI. So I think that if inflation on a headline basis is peaking or plateauing, the markets get more comfortable with that, and it takes a lot of the pressure off the Fed as well.
No, but when you look at food and energy, there's just no indication that it's backing off at all. I was talking with Adam, and I know you saw yourself today. If I pull it up, natural gas has gotten everybody's attention. It already had, and now you go over $8. I mean, doesn't that mean something?
Yes. I mean, energy, even though it's not directly part of, PCE, it is still works its way into inflation.
Yeah, it hits people in the bottom line, though, Tom,
yeah.
Right? It affects consumer sentiment. They see natural gas. They see their bills going up. They're worried about where food and energy prices already are.
That's right. And I think one of the things that we have to see is if it does soften the consumer, that becomes a feedback loop that actually weakens inflation. And but you're right. I mean, the good news is in America, food is not even 9% of CPI. Unlike the rest of the world where food is 40% of people's wallet.
I appreciate you coming down here and clarifying your tweet because it got me thinking, and thus we had to talk. That's
yes.
Tom Lee of Fundstrat. We'll see you again soon. Up next, grains and gains.